Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, as well as options, futures, and just goals in general. If you're new to the channel, welcome. To give a little background on the channel, I took basically a chunk of my net worth and I put it into what I call an all-weather high yield portfolio, and basically using a little bit of margin. And the goal is to pay my bills as well as dollar cost average back into the strategy and maintain and pay down that margin over time. So hit like and subscribe if you like what we're doing here at the channel. Again, everything done here is not investment advice, not now, not ever. So please do your own due diligence before making your own investment decisions. Excuse me. So what I want to focus on today, I want to focus on margin. Why I use it, why I think if you use it responsibly, you can use it to get ahead, grow your portfolio, and basically borrow money at low rates. So just to recap, what I'm doing currently, I am buying back into this all-weather strategy here, starting with basically TLTW all the way down to IYRI, using real estate investment trusts, REITs, precious metals like gold, small caps, S&P 500, NASDAQ, some high yielders, some index tracking closed-end funds, and then cash as well as long bonds. So diversification, I think, is important, especially in markets now where, in my opinion, there is really little to no value to be found. So margin, right? I'm basically using about 25% of my available margin. So I am currently using about $128,700. I've got about $528,000 available to me. For my own personal rule of thumb, I like to use between 10 and 30% of my available margin. Start getting a little uncomfortable when I go above that 30% mark. And the margin buffer, this is just the amount you're borrowing versus how far your portfolio can fall before a margin call is triggered, currently sits at 58.52%. So I have a cash buffer of $219,000 roughly. Now, I like to keep that margin buffer above 58%, above 50%. So 58% is cutting it a little close for me, but the main reason we'll look at it here is, I do options on the side. Also, I like to sell puts on currently blue chip companies, as well as utility companies, just for more stability across the portfolio. Companies I wouldn't mind owning if I were ever put the shares, as well as my long puts. Some of my hedges, QQQ, as well as SPY, those start eating up your margin as well. So the higher your options collateral goes here, generally the lower your margin buffer is going to go. And but if you are put the shares, typically, if I'm, let's say, BMY falls to $51 or below before this Friday's expiration, I put the shares, my margin buffer will actually go up because it's usually a 25% margin maintenance, right? Instead of 100%. So I like to just know, if I have options collateral, my buffer is usually going to go down. If I put the shares and then I sell a call on it while I'm waiting for the call to expire, and hopefully the shares be called away at a later date, my margin maintenance will fall with that. So let's explore the margin a little bit. Let's look a little bit deeper. Excuse the coughing. Thank you for all bearing with me. I know I've been breathing like a walrus on the latest videos, but some sort of respiratory thing here. Hopefully I can kick here pretty quick. So what you're looking at, just some of the margin stats, right? So total maintenance requirement of $155,296. That's basically the level my portfolio can fall to before I get a margin call. Now, it's pretty low. I've got some hedges. I've got some long puts that will appreciate hundreds, if not thousands of percents in a market crash, as well as all the diversification, right? So just between cash and bonds alone, I'm sitting at 100,000, and then gold as at about, let's call it 50 to 75,000. So just between a lot of my hedges alone, I think there's a very low probability of ever hitting that total maintenance requirement. So you always want to be aware, right? I mean, anything can happen. So I've been kind of not sounding the alarm, no fear mongering, but I do think these markets are grossly overvalued, not a lot of value. So I think we're due for a significant market correction, if not a crash. And I think that the next couple of years are going to look very different than the past few have. So always want to be mindful of that downside, right? The buffer, this is just the available cash, right, between where your portfolio currently sits and how far down it can go before that margin call is triggered. So now, right now we're sitting at about 504,000 for the total portfolio. It'll say portfolio value of what I've put in. It won't usually show the total. Okay, so usually just add the margin used plus your portfolio value. That's going to give the total of what's invested. Love the interest rate, right? Borrowing 4.5%, which is really great. This is why I moved a lot of my assets over to Robinhood, right? I've moved my Roth and traditional IRA as well as a lot of my brokerage funds because it's hard to beat. I think I was at I was at Schwab and I was paying, or they wanted, I should say, 11 to 12%. E-Trade, I couldn't get them down. Tried to negotiate with them. They couldn't meet me where Robinhood was what they were offering. So just decided to come here, use them. Now that Robinhood is offering closed-end funds again, I just think it's one of the best platforms for margin, in my opinion. So not a spokesman for Robinhood. They don't pay me or anything, but that's just, again, what I'm doing. And the lower I can pay an interest on margin, the better. Now, we can look a little bit deeper here on the individual positions. You've got your maintenance ratio. I like to keep those maintenance ratios 25 to 30% on the ETFs. Going over 30%, that starts eating up a lot of your equity. So you can see the margin requirement for a lot of these is about 1/4 of the current market value. The profit and loss, this is not accurate. It doesn't account for any of your distributions. Like WPay says I'm down $10,000 roughly. No, I'm flat to slightly up if you factor back in the distributions. So I ignore the P&L, right? It's useless on Robinhood, unfortunately. But the best way to track it is to take this P&L, add back in all the distributions you've made to get a better, accurate snapshot of your actual return. So you'll notice, for example, like on Coca-Cola here, KO, you'll see the maintenance ratio is 100. Again, that's because of the sold put. So that's why it eats up that buffer a lot quicker. The Qs, QQQ, the long put, as well as the one in SPY, it is what it is, right? Again, all I'm risking on those is all I'm risking on those two positions is the premium I paid for the insurance, right? These are insurance policies I hope to never have to use, just like you never want to have to use fire insurance if your house burns down. So it is what it is. That's going to be 100% maintenance ratio, whether I like it or not. But I think it's money well spent should a market crash come. BMY, you can see all these, AT&T, Conagra, PG&E. Those are going to all expire at the end of this week. I think most, if not all of them, will expire worthless. So that will bring my buffer back up into probably that low 60% range, which love to see my buffer and the margin buffer always increase. So this is what I'm doing here. I will be bringing over more money in January to this strategy. And 2026, making some changes to the portfolio, which we'll talk about as we go. But again, I just wanted to give you a little bit of overview on margin, why I use it, why I think if you use it responsibly, you can actually grow your portfolio. And again, just dollar cost averaging $200 back into this strategy each and every market day using margin. I only have a 25% maintenance on basically everything I'm reinvesting into. I think there's 30% on WPay, but no big deal, 25 or 30%. So anyways, hope you got something from this video today. Have a great day.